This is shocking, and this could bring the markets down along with the entire economy if this happens. Hey, everybody, you're watching Boom, Bear Bust, back with another dose of economic reality. So let's get right into it. First of all, let's just lay out what's going on here. The economy is only operational, it's only propped up by endless amounts of debt. As soon as the banks pull back on the amount of money they loan out, in other words, if credit card limits begin dropping, it's done. It's over. The economy, kiss it goodbye. It's going to be not just a recession, Great Depression 2.0, considering the levels of debt that we have right now amongst consumers, amongst governments, amongst the nation. And it's, looking like something very, very big is going to jump out of the woods. Now, I've always said here, I'm pretty bullish for the most part, except for a black swan event, except for some surprise shock a situation that comes up. Just think 2020. Just think September 2001. Crazy things that happen that bring the markets down. There's so much fear that gets pushed out there that the fear outweighs or overshadows the confidence that people have that the Fed's always going to have the backs of the markets and therefore the back of the economy, the backs of the banks, endless bailouts, liquidity to infinity, etc. If this were allowed to happen, though, this would end the game very, very quickly. Let's go over to Market Watch. The Fed will let emergency loan program expire, top official says. We've been talking about this. This is the backdoor bailout. This is the secret bank funding program that they're not calling a bailout. It's the bailout that's not actually been called a bailout because they don't want to alarm people. Because when people hear bailout, they think 2008 financial crisis, banks failing. Well, we already saw some of that here recently in the last year or two. Some banks were not allowed to fail. They were taken over by other banks, which essentially is failing, but it doesn't have all the negative consequences that it does when a bank just fails and people lose their money. The depositors got bailed out because of a get together from the FDIC, the Fed, the Treasury. Most of you remember this. And all the rules were changed overnight. And all those uninsured depositors, many of them billionaires, billionaires with a B, with Silicon Bank, got money from the government and from those entities to make themselves whole. After those banks failed, and Silicon Valley Bank, if you look into it, had a bunch of billionaires, a bunch of Silicon Valley CEOs and entrepreneurs in there. Well, let's talk about this some more. The Fed will let emergency program expire. We've had this emergency bank funding program going on since March of last year. We said here that we doubt that it's going to expire in March. It's supposed to expire, in 3 months? It was supposed to have been a 1 year program, temporary program. Vice Chair Supervisor Michael Barr says the bank term funding program worked as intended. Well, here's the thing. After it came out, instead of decelerating or declining the amount of funds pumped into the banks, it kept increasing and increasing. And even the last week, it was a new record, a new record, a new record. Every week, it set new highs for how much they had to pump into the banks to keep these banks from imploding. To me, that was not a very good sign. But according to this vice chair here, Vice Chair Michael Barr, they're going to let this expire. I will be very, very shocked, very surprised if they let this expire. The Fed has no plans to extend an emergency loan program it launched last year to bolster the capacity of the banking system in the wake of the collapsed Silicon Valley Bank. You notice how they word that, bolster the capacity of the bank. Now, it was rescuing the banks because so many people were pulling their money out of the banks. It would have been a whole string of bank failures if they were not able to keep them funded with this program here. Folks, if this is allowed to happen, this could be an economic collapse like we've never seen before. That's why I doubt they're going to let that happen. In 2024, when we have the events of November 2024 coming up here and the selection, I really doubt they're going to let this happen. But that's one of the Vice Fed chairs is saying. He's saying they're going to let it expire. I think it's just talk. I think it's just lip service. Again, if they let it expire, the banks are in big, big trouble. You're going to see credit card limits drop. because the banks are going to have to be very choosy on who they loan money to if it were not for this emergency funds injected into the banks. And what happens when people stop, uh, or when the ability is taken away for people to put more debt onto their credit cards? Well, people not just won't be able to buy things they want, they won't be able to buy things they need because people are living off of credit cards, paying their utilities, buying food, and without credit card, but car repairs, they wouldn't have cars in many cases because they don't have enough money put away in savings to even pay for a car repair. We talked about that here in this channel several times. So the credit cards are a lifeline for not just a lot, most U.S. consumers. People are literally living off of these credit cards. So if you take away the bank funding, the emergency program, and banks have to start cutting credit lines on these credit cards, look out below because that's going to be the dagger that finally kills the economy. And think about this: a lot of the jobs that are out there right now are only in existence because of the ability to take out credit cards. One person's debt is another person's job. When you have a lot of people with debt, or a lot of people with credit rather, to go out and spend money, that creates jobs, that creates economic activity. When the opposite happens, when banks stop loaning out money, when credit card limits drop, economic activity drops. That's when you see a big surge in layoffs. Now, some people were saying, oh, we had great jobs numbers. Well, keep in mind, they counted second jobs, third jobs. They counted people going back to work after strikes and different pauses. They counted those as jobs added as well. So that jobs number was a pretty big scam when you look at the real numbers, the real data behind it. All right, let's go ahead and transition a little bit here. The holiday numbers are out, and we talked a few episodes ago about this phantom debt, debt that actually doesn't appear on all the credit bureau credit reports, known as hidden debt, from these buy now, pay later programs. And how bad was it? Well, holiday shoppers put billions on buy now, pay later plans. And now we're already seeing missed or late payments that are going to make things even worse for the people that ran up all this debt over the holidays. Holiday shoppers now face a financial hangover. Debt that includes the increasingly popular buy now, pay later plans put shoppers into an additional $16.6 billion, that's billion with a B, further into debt. And in many cases, this was just added on top of the debt that people already had because, again, most people aren't paying off their credit cards. And naturally, you see this right here. U.S. credit card balances hit a new record as delinquencies rise in the background. Folks, when people cannot go further into debt, then it's game over. So here are the delinquencies right now. We see a big spike here if you look to the right side from the lows there in 2021 going into 2022 to now a big spike, and now we're beyond where we were going into 2020. Remember, going into 2020, we had several years of increasing delinquencies. It was very slight. This most recent rise is similar to the slope and the rise that we saw going into a financial crisis if you look to the left side of the chart here. So that's why I say, look out below because this could really accelerate and cause some financial hardship. Now, this doesn't mean I'm a perma bear, nothing like that at all. No, I'm actually still bullish. But if this program ends or some other situation comes up that's going to be a shock to the system, to the debt-based economic system, that's when you're going to see the market come down. Until then, I think it's still going to be further upside to the market, further upside on the cost of living, inflation, except for a couple areas, rents and autos, and also home prices. But let's talk about rents out of Newsweek here. Rents finally dropped below $2,000 a month. This is a sign that people no longer have extra money to just pay whatever for rent. And it gives us some details here on some of these cities that saw falling rents, actually. Las Vegas, median rent, $1,531 a year. That's down 6% year over year. Riverside, California, median rent, $2,300, down 5.9%. Phoenix, $1,663 a year, down 5.7%. Austin, Texas, $1,641 a year, down 5.6%. I'll just give you the percentages. Tampa, Florida, down 5.6%. Let's see where else here. Charlotte, North Carolina, down 3.5% year over year. Atlanta, Georgia, down 3.1%. Denver, 3% drop from a year ago. Seattle, Washington, down 1.8%. In Virginia Beach, Virginia, down 1.6%. We told you this would happen when the eviction moratoriums ended, and the more debt people have, the less they have left over if they're still making their payments. The less they have left over to pay rent. So this is going to be more falling rents unless they come out with some other new program to prevent this or to stop people from getting evicted. The World Bank is warning global economy headed for the worst half decade in 30 years. Again, this is based on all the debt out there. When people can't go further into debt, then the game is done. But now we have the threat of war. We have the U.S. involved in many different conflicts, not just financial backing of different countries, but boots on the ground and even casualties. We've already seen casualties with U.S. troops here. So we're definitely involved in these wars. A lot of hostility around the globe against the United States right now. So be ready for something big to pop up here. Could it be World War III? Could it be nukes? What else could it be? We're seeing attacks and other countries, hostile nations, looking to take down our grid. That would be the perfect thing to bring down the economy, and that way the central planners wouldn't take the blame for it. They could say, "Oh, everything was fine until this happened, until the surprise shock situation came up that brought the markets down." Right? Just think 2020. So look out, folks, because this could be 2020 2.0 here with all the risks I see out there. But at the same time, keep stacking, keep investing. Silver, I'm accumulating more silver every 2 weeks. I buy another few ounces, sometimes 5 ounces, sometimes 15, 20 more, but usually a few ounces each 2, 3 weeks. A new order comes in. So I'm continuing to stack, continue to look for investment opportunities, but at the same time be wary and ready because there are some corrections happening with prices, and the markets could come down. The markets could come down big time if this emergency funding program is allowed to expire. What do you think? Will they let it expire? Or will it just be business as usual? They're going to keep it going. They're going to extend it just like all these other programs they had to extend. And the ones that actually ended, we're now seeing some carnage and some price corrections, right? So we'll like to read your comments on this one, folks. What do you think? Please give us a like and a thumbs up if you like what we talk about here. And we'll be back very soon for another economic dose of reality. We'll talk to you very soon. Bye now.